Welcome back to Market Call. Time now for Jordan Zinberg's top picks. Main Street Equity is number one, ticker symbol MEQ on the TSX.
Yeah, so Main Street specializes in acquiring and fixing small apartment buildings in Western Canada. They've been at this for over 20 years. The company is extremely well run. It's actually one of the best compounding stocks in Canada that no one seems to really talk about. The stock's returned 20% annually for the last 20 years, which very few stocks in Canada actually have. During COVID, they played it perfectly, went out and did a bunch of acquisitions, locked in a bunch of their debt at 2% over 10 years, which is fantastic. The company's very well positioned given Canada's housing shortage as well. We've only got 2 million apartments in Canada. We had 1 million immigrants come in last year. Vacancies are at 2%. So I think Main Street is right in the middle of where you want to be given the housing market environment in Canada right now.
Interesting. I'll just take a quick look at the analyst consensus there. 3 analysts cover it, all say buy on Main Street. Okay, number 2, Lumine Group, ticker symbol LME on the TSX Venture Exchange.
Yeah, so this is actually pronounced Lumen. This company was spun out of Constellation Software, which I'm sure a lot of the viewers will know, earlier this year. Unlike Constellation, they specialize in a specific vertical. They specialize in vertical market software for media and communications only. Also, for those who are familiar with Constellation, a little bit different in that they tend to do larger deals, typically about 2 times the size of what Constellation would do in the past. It's very similar financial profile to Constellation. I think it will get more attention over time. There won't be analyst coverage simply because the company has a lot of high internal cash flow. They won't need to raise money. But I do think over time you're going to see a similar return profile to what we've seen from both Constellation Software and Topicus, which was Constellation's first spin out back in 2021, and the ticker on that one is TOI.
What does the company's profit and sales growth look like?
It's fantastic. I mean, it's like Constellation. It's off the chart. Not a lot of organic growth, mind you.
Right.
Primarily M&A. They've done about 25 acquisitions so far. The other thing they do a little bit different than Constellation is they'll tend to buy corporate carve-outs from larger companies. That's not something we've typically seen in Constellation's M&A playbook. So very similar to Constellation, some small nuances. I think will be a great winner over time.
Okay, and the final top pick on this day, Source Energy Services, ticker symbol SHLE on the TSX.
So as I alluded to earlier, I've been digging around in the oilfield services space, discovered Source, which is not really well known to investors, but is the dominant player in Canada for frac sand. So over 50% market share in Canada in frac sand. Profitability is improving dramatically this year because they had a bunch of long-term contracts, which they rolled over earlier in the year at much higher prices. So we saw that profitability in Q1. We're going to see it again in Q2. Second key part to the story is deleveraging. So the company does have some debt, but they've got a lot of cash flow now. They'll be paying that down. Just to look at some numbers quickly, high level, we've got a company with a 60 million market cap that should do over 500 million in revenue this year, 100 million in EBITDA, and 40 to 50 million of free cash. I think analyst EPS estimates for this year are over $2. You've got a share price, I think when I left the office, of about $4.30. So companies trading on 2 times earnings with a huge return on capital. I think this stock, if we do see the deleveraging and the profit growth I'm talking about, this is an $8 to $10 stock by the end of next year.
Does a lackluster price of crude oil create a headwind for the stock, at least in terms of perception?
Well, their fixed contracts are with large E&Ps, which I think as long as oil stays above $70, I don't think we're going to see any of the large E&Ps reduce their capital spending programs. But if we saw oil at $50 for a prolonged period of time, yes, absolutely. With LNG Canada coming on in 2025, I just see all the companies ramping spending and going the other way. So fantastic stock, super cheap, not very well known, and lots of catalysts.
Jordan, on behalf of our viewers, thanks a great deal for being here today.
Thanks, Paul.
Welcome back. Let's go to top picks from Shane Obata. Top pick number 1, Broadcom, ticker symbol AVGO. Shane?
Yeah, Broadcom has been a great name for us, and we're continuing to hold this as a top pick or one of our core positions, especially in our tech mandates. So this is a pretty well-diversified company. It's mostly a semiconductor company, but there's also a very slow-growing infrastructure software business. And what we're really excited about lately, we're talking about where else to look besides NVIDIA when it comes to AI. So Broadcom is going to be, we think, one of the first beneficiaries after NVIDIA. And the funny thing is, unlike Jensen, who's the CEO of NVIDIA, and he's always fully embracing whatever trend is coming his way, right? So he's saying, generative AI, this is the next iPhone moment, for example. So Broadcom's management is more conservative. They're kind of taking it as it goes, and their estimates are that AI-related revenues will grow to 25% next year from 10% in 2022. That's based on actual orders and not just them hypothesizing about what can happen. And so there's two important areas that they're benefiting from. So the first one is these custom chips that they're building with companies such as Google and Meta. So I think these companies looked around, they said, okay, we don't really love how much power NVIDIA has, so why don't we try to build some things internally? So we've seen it with Apple's M1 chip, we've seen it with Google's TPUs, Amazon and Meta all doing their own chips internally. Well, some of them are partnering with Broadcom to do this. And they're built to do Google's workloads, for example. So this is multi-billion-dollar partnerships. So the Google partnership was already in the billions, and then the Meta partnership is expected to get into the billions. So these are going to be significant parts of the business very soon. And the other part is on the networking side. So to explain this at a high level, basically, when we want to do more AI computing, we need more computing power, we need more GPUs, we need more CPUs, we need more of that power, but we also need to make sure that our networking capabilities are going to match. So we need to make sure our bandwidth is high, how much information can be translated or moved around, and also the speed of that. And another thing that's going to become increasingly important is how energy efficient it is. And so all of those things, we think Broadcom is doing well with its networking chips. So exposed to AI in a couple different ways, but that's not the whole story. We like the whole business, but we do find that exciting.
Okay. Blackstone is number 2, top pick on this day, ticker symbol BX on the New York Stock Exchange.
Right. So I pitched last time, I think I was on, I pitched Brookfield Asset. It's the same idea. We think that the alternative asset space is dominated by a small number of companies that just have tremendous scale. There's only a few businesses that can do the deals at the higher end. We've seen Brookfield on a deal-making spree this year, for example. They just have good scale and best practices they can share across businesses. So Blackstone started in private equity, but has become much more diversified. Most of the business is actually related to real estate now. So they've been caught up in the same concerns that we've seen in the market about commercial real estate and whatnot. They're much less exposed than Brookfield is. They have said that office represents just 2% of their US real estate portfolio now. So we think likely this is going to be a difficult year, maybe 6 months to 18 months for Blackstone, given the real estate environment. But the overarching macro is that we think we're getting close to the peak in rates. That should help the real estate market. It should help deal making. And Blackstone has over $190 billion of dry powder. So when some others are under pressure, they have the ability to make good acquisitions. So it's a story that we think will play out over time. We expect that they can do easily 15% growth in fee-related earnings over time. So it's a great company. I would consider them the best alts manager in the world.
Okay, let's go to Nintendo. It's a Japanese traded stock in Tokyo. It is, of course, a gaming company, and there you see its ticker number on the Tokyo Stock Exchange. Shane.
Yeah. Try something different here with a Japanese name, but I think the Japanese market has been very strong this year. It's becoming more shareholder friendly, and when you look outside of the States, you often find more value, right? So I think people will continue to be interested in Japan. Nintendo doesn't fall into the deep value camp. It's forward P's like 20 times. This is a little bit of a nuanced story here because they're heavily dependent on console sales. So the Switch was tremendously successful, selling well over 100 million consoles. But when you reach year 3, 4, 5, 6 of your console cycle, your sales naturally decline, and even if you're still selling games. So this is a company that could have to deal with negative sales growth for the next couple years. But what we're excited about is with the launch of the Super Mario movie, which was a blockbuster, I think it was 1.3 billion in worldwide gross, which is pretty awesome. The whole idea of IP synergies across divisions, which we've heard many times from different companies, this is a company that can really do that. And so the basic gist of it is you take IP from your video game franchise, Zelda, Pokemon, Super Mario, and then you make a movie or use it in some other format. And then when people watch the movie, that drives console sales again, and that drives video game sales again. And so we think that kind of fortuitous wheel can continue to help Nintendo and help the company probably surprise to the upside, even though the expectations are quite low.
Shane, thanks a lot for being here. Let's go to top picks from Andrew Pink on this day. Number one is Exchange Income, ticker symbol EIF on the TSX.
Yeah, Exchange has been a very long time holding. We like Mike Pyle, the CEO, and the rest of the crew there. This is a business that essentially acquires companies in two verticals, in aviation services and in manufacturing. They make accretive acquisitions and they bring capital and expertise. They let the companies run on their own. It's been a really consistent, long-term holding. And I think over the course of their 19-year history, they've grown the dividend 5% annually every year for the last 19 years. They've returned just south of 20% annually over that time frame. It's a repeatable business model. They're winning contracts. They recently did a equity financing, $172 million equity financing. And they won a big 10-year contract from the government of BC and another one from Air Canada to run regional flights out of Eastern Canada. So these are very, very good contracts. They've got somewhere between 2.5 and 4-year payouts. Really good company. We like it a lot. They've got about $1 billion in liquidity, so they can look for the next opportunity.
Okay. Nexus Industrial REIT is number two. Ticker symbol here is NXR-U on the TSX, or .UN. It's a REIT, so it comes by way of units. What do you think of Nexus?
Nexus is it's a small cap, so you got to be a little bit careful there. It can be volatile. But it is a company that was a diversified real estate company, and it's now turning into a pure play industrial. We love the industrial theme within real estate, and I think I talked a little bit about that with Shopify, and Amazon's doing the same thing. I think that's a really good space to be in. This is a company that's got it's low cost, low capital intensity, pays a 7.6% dividend. They've made a really big headway into the London market. I think 28% of their NOI comes from London, Ontario. This is becoming a real hotbed for activity. For transportation and really you've got highways that run east and west, and you got one that runs south into the States. So companies that have distribution really like that hub, and these guys have a strategic partner in London who are interested in vending in assets to their business. So it's they really have done a good job, and as I say, they've grown to over 90% of their NOI comes from industrials now. That's up from I think 70 when they started this program. And I think they can get to 96%. So they become a pure play industrial in probably the next 6 months.
Okay, number three is TD Bank. It is a stock that is getting about 2.5% cheaper today because the market is down, and TD is the most influential decliner on the TSX right now. Why do you like TD?
Well, I was going to say the share price has lagged by about 6%, down 6% year to date. I guess down 8% now, looking at that chart. It's lagged the group for a very specific reason. 30% of its business is U.S. retail. And what we know happened in March, the U.S. Banking segment came under a significant amount of pressure. And that was after a couple of bad characters, including Signature and
Silicon Valley Bank.
Essentially, the regulators are not really looking at that level, the regional banking system, the way that they should have. And there's going to be some bad characters. There's a lot of regional banks, and they ran their business a little bit too overextended, and what I believe happened was they essentially locked into a longer duration bond and couldn't fund deposits, and that essentially happened. This took TD down, so it's really been under pressure since then. They were also going under, while that was happening, they were trying to buy First Horizon North, and that deal fell apart. So the market has a little bit of mixed feelings and negative feelings about TD right now. I think it's a very interesting company to look at. Typically trades at a premium to the group, so 2-3% premium. It's trading at a discount right now. I think you can buy a high quality company at a discount valuation. You're getting a good solid dividend. They have a significant amount of capital on the sidelines, so their CET1 ratio is through 15%. It means they have $16 billion to deploy into either M&A or increasing their dividend, NCIBs, or potentially just investing in the business for growth.
Andrew, thanks a lot for being here. It's time now for top picks from Jamie Murray. Top pick number 1 on this day, Thermo Fisher, ticker symbol TMO in New York. Jamie?
Yeah, so Thermo Fisher is one of the leading healthcare providers in terms of providing services to pharmaceutical and life science companies. They have a variety of products and services that they've built up over the years through acquisition. So companies can go to Thermo for running a clinical trial, developing a new drug. They have a huge diagnostics arm, as well as selling products like electron microscopes and anything you really need to build a new drug or just to develop a new biologic. And this is a company that was a strong performer, really benefited from the COVID boost. Obviously, the diagnostics arm, Thermo Fisher, sold a lot of diagnostics tests, but the development of the vaccine as well really provided a huge boost to their revenue in that time period. And then over the last couple of years, as COVID has kind of dwindled away in the developed world, those revenues have fallen. And so the stock had a big run up, has kind of traded sideways over the last couple of years. But right now we're seeing Thermo Fisher trade back at a 20 times PE ratio. It was traded up as high as 30 and can get up as high as that level when times are good. And so we think we're going to see an acceleration in its revenues and earnings as we come out of this post-COVID period. At this $20 mark, it's a great entry point for one of the best-in-class medical technology companies out there.
Okay, Broadcom is number 2, ticker symbol AVGO on the NASDAQ, and I think this stock has experienced a rally based on its exposure to AI.
Yeah, and that's really what's driven the move in the last, call it 2-3 months, is its exposure to AI. And I mean, NVIDIA is sort of the poster child for the selling picks and shovels into the AI boom. NVIDIA sells the GPUs, which do all the computing that is required for these large generative AI models. And the interesting part about generative AI is that you require tons of computing power. And in terms of hitting a next breakthrough, it's really just a matter of throwing more and more and more resources at it. And that's really how that ChatGPT almost came out of nowhere. It was in development for 3, 4, 5, 10 years. And then it finally gets to be a powerful enough model where it can do all these crazy things. And so Broadcom sells other network equipment that connects these GPUs together. So they're part of that membrane, but it doesn't have the valuation that NVIDIA has. It only trades at about 19 times earnings. And then it also has a broader sort of end market of users or companies that buy its products. So a little bit more diversified, a lower risk way to play the AI market. And then just the other part with Broadcom, they actually are looking to acquire a company called VMware, which they're going to integrate into their software arm. That's going to be a hugely accretive deal if it gets all the competition approvals. So a few different catalysts here for Broadcom shares that we think is going to continue to drive the stock higher.
Okay, and number 3 is Air Canada, right here on the TSX.
Yeah, Air Canada, this one's a little bit more simple and an easier play for Canadian investors. I mean, the stock's sitting at 52-week high in the last few days. And Air Canada is really just playing the rebound in travel. We're seeing strong rebound in the domestic market, but Air Canada, at least globally, has one of the best exposures to cross-border travel. If you want to fly to the U.S. from Canada, it's the number 1 carrier at the most stops. We're seeing the Asian markets recover as well, and Air Canada has a good exposure to that. And then obviously the European travel is returning too. And we see it trading at a PE ratio of, if you go out a couple of years, even 8 times PE. Very strong free cash flow. They actually raised their free cash flow forecast for this year to be $1 billion higher, so $3 billion instead of $2 billion, based on lower fuel prices. And we see this continuing. We're going to see them pay down some of the debt they had to take on to get through the pandemic. And ultimately, as the Canadian economy continues to grow, we think Air Canada stock will grow with it. And we see a $30 share price in the next year or two, and moving even higher from there.
Which profit metric or version of profit, if you want to call it that, do you pay most attention to at Air Canada or at an airline stock generally? They report revenue, they report net income. It's often a loss because of accounting items. They report adjusted net income, and they also report something called EBITDA, which adds aircraft rent onto the other items that make up EBITDA.
Yeah, and EBITDA is typically the industry's favorite way to look at these companies and these heavier capital equipment companies. It's not really our favorite metric. We find there's too many items that get missed in EBITDA, particularly capital expenditures and depreciation. So it's not our favorite way to look at it. We like to look at free cash flow and earnings if it's there. And as we said, as Air Canada moves through this period and paying off some of these loans, reducing its interest costs, we think it's going to see EPS of upwards of $3 a share. So that's what we're looking at, and that's what we're valuing Air Canada on.
How much of a difference does it make, if anything, that its chief competitor is no longer publicly traded, WestJet? Is the audience for the stock, the potential pool of buyers of the stock, more focused now on really the only option in the market?
That definitely is true in terms of getting pure play exposure. Of course, you can still buy the private equity owner Onyx of WestJet and get exposure to WestJet through that. But we just really like Air Canada, again, more particularly as the cross-border travel comes back, that they have the most exposure to that. And so that's why we prefer Air Canada, even if WestJet was a publicly traded company.
Jamie, thanks a lot for being here, and
Yeah,
thanks on behalf of our viewers for all those answers.